Welcome to the Prime Property Finance Podcast with Gareth Morgan and Mark Watts. This unique podcast will dive deep into all areas of property investing finance, going behind the scenes with property professionals, investors and clients. Between us, we have 35 plus years experience in property finance. The podcast has been launched to share knowledge, mindset requirements and experiences of successful investors and professionals. We aim to simplify many of the complicated areas of finance and investing and provide valuable and easy to implement tips. Keep an eye out for our new longer episodes every Tuesday and our shorter ones every Friday. If you're an investor right now, it probably feels like the market is constantly shifting. Rates are being pulled, products are changing, lenders are tightening and loosening almost weekly, and there's a lot of noise around what's actually happening next about this conflict and how that impacts the market and the economy. Some investors are pausing completely, others are rushing in, and most are somewhere in the middle, unsure about what actually the right move is. In this episode, we're going to break down what's actually happening in the market and the economy right now, why lenders are behaving the way they are, and most importantly, what you should be doing depending on your position as an investor. Mark, welcome back. Looks like there's been some interesting things going on in the market. How are things?
Interesting. That's the understatement of the last 2 weeks, I think, for sure. Yeah, good. Highly pressurized, ever evolving, ever changing in terms of rates and everything like that. So, yeah, it comes with its pressures, but hey, that's what we're here for, right?
Absolutely. And so in this episode today, we're going to talk about what's going on at the moment since the start of the conflict in the Middle East. It's been a really busy few weeks in the mortgage industry. There's been a lot of news, and we just wanted to cover off a bit more about what we're seeing. Mark did an episode around what is happening in regards to swap rates and specifically why those rates are changing like they're changing and how that affects the market. But today we're just going to go into a little bit more detail on that and a bit of a wider picture about what you can do to control what you can control, not worry too much about what you can't control, and just a bit of a wider piece from an investing perspective. And we'll talk a bit about products as well. So, ultimately, the position we're in at the moment is that mortgage rates are now the highest they've been for 19 months, which is obviously, a concern generally in the market. I think we had a good start to the year. End of last year, we had a drop literally just before Christmas after the budget, which, when people were sat on their hands a little bit, and we just started to see that bit of movement, a bit of normality. We have bi-weekly team meetings in the office, and one of the things we talk about is market news. And, for us, no news is good news, quiet markets, everything, business as usual is good for business for us. It's everyone carrying on. And then, not too long later, certain people decide that they want to do certain things in different parts of the world, and then that just causes all sorts of chaos and mayhem for everybody else. So we're now picking up the pieces where we can, but ultimately this isn't a short-lived item, is it? This is not going to come to an end in the next week or so. So this is the new landscape that we have to navigate, and we just want to try and help kind of position it and just share our experience at the moment and what's going on and what you can do to do it. So what is actually happening right now? I know you've covered that off a little bit in the last episode, but do you want to just give us a high level roundup of what's going on?
Yeah, sure. So obviously, unless you've been living under a rock for the last 3 weeks, you'll be aware that there's a conflict between the US and Iran, which is having a severe impact on the global economy. The US is feeling the pain as well, and we're obviously getting the side effects of that in the UK. So it's manifesting itself into the mortgage market, and that's coming through in something called the swap rates. So I covered that off in a previous episode, but real quick, swap rates is effectively the money market. It's where banks go to buy their money so that they can subsequently lend that back on again. As I say, I've covered in a bit more detail. So check out the previous episode on that one. What it means is when you are buying, so let's say you want to fix your rate for 5 years, the lender has to go and get their money fixed for 5 years also, and they pay a price for that money, and then they subsequently lend it on to you with a margin, and that's how they make their money effectively on mortgages. So because of the conflict it is obviously, as I say, having an impact on a number of areas in the economy. And we expect it to find its way into inflationary figures, because with the restriction or the disruption to the oil supply, it is going to impact all sorts of areas of trade, which is going to be transportation, manufacturing, and all that sort of stuff, which is then ultimately going to be passed on to the goods. That will then feed inflation. And when inflation goes up, there is pressure on the Bank of England to increase prices to try and curtail spending, because usually inflation means people are spending too much. However, this is born out of, as I say, a global conflict. As such, then they are pricing into the swap market that they anticipate rates to go up. And that's because of the changes that are happening. And Trump put in a post out on Truth Social versus what is actually being said. It's just all over the place. There is no one steady narrative. It's just all over the place. So the markets don't know how to react, basically. And that's why we find it in the swap market. So just to be clear, this is different to the Bank of England base rate. The Bank of England base rate affects your variable rate mortgages, such as your tracker mortgages. We're specifically talking here in a swap market around fixed rate mortgages, 2 years, 5 years, 7 years, 10 years, etc., etc.
Yeah, and so there's a couple of interesting things. We look at those, what changes have happened shortly, but I just wanted to kind of give an example of a client that I spoke to this week, a couple of days ago, I think it was, yesterday maybe even, where their central heating is oil fired. And so when they're coming off a mortgage, which they've had for a 5-year fix, is coming to an end at 1.39%. So that's coming to an end soon. And so they're concerned, and it's not a small mortgage, so they're concerned about the rises there. And secondly, they bought 2 weeks ago, they bought 500 litres of oil at just over £300. The exact same 500 litres today is just over £1,000. So if you look at that, that's just one example of somebody who's using that as, their main source of heating, and how that impacts. And when you talk about inflationary pressures caused by the oil prices, and those sending things up, the impact that actually on the bottom end will be deflationary in some respects, because this will impact people's disposable income, because they won't have as much money to spend, and therefore naturally will retract from buying things. And that's going to impact businesses then in a different way. So, the costs of things are going to go up, but also they might see a pullback in demand as well. So it's going to be an interesting few months ahead for sure. And, again, this all leads into people kind of starting to sit on their hands, a bit of nervousness. And, we'll talk about a little bit about the media as well and their part in it. But there's a lot going on right now. So, anything to add to that?
Yeah, just in terms of the inflation thing. So this is not that dissimilar to what we saw with COVID, when inflation was through the roof. But I appreciate there was a lot more cash in the system there and so on and so forth. But this is one of those scenarios where the inflation is going to be driven by oil prices. That isn't necessarily a spending, but the Bank of England only have one instrument to control this, and that's the base rate. So their natural response is going to be to increase rates to curtail the inflation, but the inflation is baked into the system as opposed to people spending. So it's definitely going to impact people's cost of living. We're already got pressure in that space as it is. This is just going to further enhance that. So when you add on mortgage interest rates and so on to that forms part of that equation, and that's why this is becoming critical in some places. As you say, 3 times the price for oil just to heat your home. Good job we're moving into summer. So hopefully that means they won't be burning through it as quick. So
yeah. So let's just quickly look then at what are the changes at the moment. So we're seeing the rates. So just to give people a flavour of what's going on, the average 2-year fixed rate is now 5.75%. And that's up 0.92, so almost a full 1% increase since the start of the war. And then in regards to the 5-year fixed rates, they're up to an average of 5.69%. Before it was 4.95, so that's an average of 0.74 increase. So 0.75% on 5 years and on almost 1% on 2 years. So as we've talked about a little bit. What does that mean? That the market is pricing short term, so 2-year fixed rate is more expensive than a 5-year fixed rate, because they see the volatility in the short term being higher, and then people were expected to settle back down over a longer period.
Yeah. So with that, what it looks like is, just to explain why that would be the case in the two, because we normally see 5 years more expensive than 2 years, because it's easier to predict in the short term than it is in the long term. So why is this the case? Well, they have to, because they're buying money in, they have to assume that certain things are going to happen and try and predict where the market's going to go to make sure that they still have a margin on that money. Therefore, and this is the same with the swap markets, because everybody has to pay for the money at some point. So what they're saying is it's really hard to know what's going on. So we're having to push the price right up just in case something else goes on. And we have to give ourselves such a margin for error because of the volatility. That's why you're seeing that happen. Now, the margin for error, they're calculating less because you'd like to think this isn't something that's going to be impacting us for the next 5 years. However, it's realistic to assume that it's going to affect us for a good 18 months, 2 years. I mean, some of the infrastructure issues that have happened, they anticipate it could be 10 years before the full supply comes back online. So this is going to be a longer term impact. So I don't see that we're going to see stability for some time. So that's why the 2 year is priced higher than the 5 year.
Yeah, absolutely. And then just a nod towards how many products. So we mentioned that some lenders have just completely pulled the products. So they don't currently have any products available. Others have pulled them and have increased them. So there's lots going on in that regard. There's a lot to navigate from our perspective. To just give you a flavour, there's over 1,600, that's 1,600 fewer products on the market today than there were on the 9th of March when this all started kicking off. So just goes to show how many products have been pulled and how difficult that is, to get some deals through. We're going to talk about the news element of it a little bit later on. So I'm going to just pause on that part. Anything else to add from your point at this stage?
No, nothing. No.
Cool. So let's move on then. How does this impact investors? I know we've probably touched on it a little bit, but how does the speed of change and kind of the decision-making process, those types of things. I've got one example. We sent a quote to somebody 3 weeks ago. They came back, they've come back, they've obviously not done anything with it. They sat on it. And then obviously they probably watched the news and you heard the mortgage rates are going up, and then they came back and say, I'd like to go ahead with that now. Well, obviously it doesn't work like that. And, we're caveating that, we are getting, and just to give people a picture, we will get phone calls or emails at 4:00 to say, just to let you know, these products are being pulled at 5:00 today. And you might have 4 cases that you want to submit on that product. So you've got to decide which one, for instance, and then you make a decision and on merit, whatever. And then you go to put the application in and you can't get into the lender's website because it's crashed because everybody's trying to do the same thing. So it's a very difficult market from a broker's perspective to navigate that. And, I think it's probably now is a good time to remind people that, we're on your side, but it is a challenge to navigate all of this stuff. And we're working hard in the background to make sure that we're staying on top of it, to make sure that we can get everything we can through and fight things with lenders when they're trying to be challenging, but it is difficult.
Yeah. And so just with this in mind, and who does it impact, there's 2 different types of person, or 2 different types of scenarios really that we deal with on a day-to-day basis. There are people who are buying property. Okay, so people who are purchasing versus people who already have a property and need to remortgage because their rate is maturing. Okay. The ones that this is impacting most is the people who are being forced into a decision. So the options that you have right now are going to be, I'll change onto a new lender, I'll stick with my same lender but choose a product from them, or I'll do nothing and sit on this standard variable rate, which, as you can imagine, is priced extortionately again now. So those people are unfortunately in a time where a decision has to be made. Now, those are probably going to feel it most because there's not an event that's going on. It's just, as I say, that maturity piece that's happening. The others then, and we'll have conversations on both, is around those that are purchasing and what their decision making now looks like versus those that have to do something today. So As you say, what we are seeing where it comes to product transfers, if you are going to go into a new lender because there's a better deal elsewhere, then those are the ones that are probably going to feel this pinch a little more because they haven't got the comfort of some time to make that decision. They're going to be pushed onto a rate which is even less attractive to the one they're being presented right now. So that is something to bear in mind. So if you are really considering mortgaging, your PT or your product transfer rates will also fluctuate during this period. Now, what we are doing is putting people into products, securing the product, whether that be through applying with a new lender or committing to a product transfer with their existing lender. But then you still have some time to change your mind during the process. So if the rate goes up, you're locked in at the lower rate. Equally, if the rate goes down, we've got some movement where we can put you onto the lower rate. So it tries to hedge, if you like, against that rate change. And that's what I would probably suggest that most people who are in that position where they have to do something, be decisive now, because my gut feeling this is going to get progressively worse unless this conflict is brought to a pretty hasty conclusion.
Yeah, great points. Thank you, Mark. In regards to the other points that people need to navigate, and this is the bit that we see, and obviously the social media noise around all the different things to do with the conflict and World War III and whatever it may be, and the scaremongering, and then those headlines that amplify fear effectively. And we've talked about that, the way the news articles position, rates have gone up and it's raised costs by over £1,000, and they'll find a figure that makes it a four-figure number rather than a three-figure number, just to play on your mind and just to get it under the skin and make you nervy and tetchy, etc. And that feeds into the key part for us, from an investing perspective, is, the old Warren Buffett principle around be fearful when others are greedy and greedy when others are fearful. And as the market drives those decisions, and as the market drives the fear rather, then just be mindful about what you can do from your own perspective to manage your own economy. And that means I spoke to an estate agent this morning who said that some of the properties they've got at the top end of the market are sticking. The reason they're sticking is because generally that's because the things don't come through from the bottom end of the market. And as things, you need the bottom to push on the next layer and move change along. Now, if people sort of pull out because they're fearful, maybe a first-time buyer will decide, do I want to buy now because the rate's gone up and it's now not affordable? They might pull out, but the person that's selling that house is ready to go up the ladder and is set on buying their forever home. And so there's an opportunity there now that for an investor where that first-time buyer may have pulled out and there's no other buyers now because of all the headlines to come in and make an offer and potentially get a good deal. So those people who are ready and willing and able, then there will be dealers. And this isn't about, taking out first-time buyers from the market. Well, if those buyers are still there, then great. But if they're not, and the economy still needs to go and other people still need to move, that's where there is potentially opportunity.
Yeah, definitely. So one of the articles that we looked at, wasn't it, was so the quoted rates have gone up from 4.89% to 5.5%. Well, we've confirmed that they've gone up a bit higher than that. So, but they sort of cited the average mortgage, taking a typical mortgage of 250,000, that takes the borrowing costs over 12 months to an additional £1,000. When we looked into it, the average mortgage is between 155 and 190,000. So again, that speaks to trying to pick a good number. That is much higher. And look, I'm not taking away from the fact that things are going to get more expensive. If you are in a position where you have to remortgage right now, you're going to end up paying more for your mortgage, typically, than what you did from when you secured it previous. That being said, we're also in that window of opportunity, a window of renewals now where people didn't have a choice and took expensive mortgages anyway. So expensive compared to what? So what I would say is don't get dragged into the headlines. Understand your own what does this mean to you personally and what's your own impact? Like everybody has their own inflation score, because there's certain products in the inflation number that you just wouldn't use. If you don't drink alcohol, then the duty, tax duty on alcohol doesn't impact your own personal inflation score. Similarly with this, with interest rates, your mortgage, what is the impact of it? If you're in Wales and you've got a property and you've got a £50,000 mortgage, in reality, a 0.25% hike per annum is negligible. If you're in central London, I've got a £1.5 million mortgage on something, a 0.25% hike on something is substantial. So again, it's just be relative to your own set of circumstances rather than just buying the number out of a headline.
Absolutely. So the things really that we want to just focus on is, what should you be doing right now? And if you're an active buyer, then, things like maintaining contact with the broker to make sure everything's up to date, being able to, if you are wanting to be buying, then be getting everything in place so that you are able to move quickly when the right product fits. And it's also not nitpicking over products. Like we've kind of just said, that this is going to be the landscape for a little while now, and hanging around just to try and save a 0.25% or 0.5% or whatever. If the deal still stacks, which it should do, because you should have stacked it with plenty of stress tested in there, then just go for it and don't hold back really. But don't be foolish. Build flexibility into your deals. Is there a potential to renegotiate if you've already agreed a deal? And then obviously don't overstretch your assumptions. Like I said, just make sure you're stress testing to the nth degree. So being prepared and being ready to move quickly will provide you with plenty of opportunity. In regards to portfolio landlords, then review your existing rates and do that early. Make sure you have got, check your expiry dates, plan refinances early, like you mentioned earlier, Mark, around let's lock something in early, and that gives us the opportunity to get something lower later on, but you are hedging by planning that and just analysing, obviously analysing your overall portfolio performance. If you're going to sit on the sidelines, then, just waiting for the right time is, another old saying is, don't wait and buy property and wait. And this is an example of that. It's just get in, get it done, and long-term prices will increase. So don't overthink it sometimes.
Yeah, and look, I think we've covered this previously as well. If a 0.25% increase in interest rate is a make or break in your deal, it's probably not a deal, because there are far more variables that come to whether that deal is profitable. Finance is one part of the equation. You've still got your operating costs and everything else like that. So if a 0.25% move in an interest rate, whilst it might be less favourable, I get it, but if it's breaking the deal, it's probably not a deal in the first instance.
Yeah, absolutely. So, things just to be mindful of on top of that is just there are going to be changes. So just speak out and see how we can manage that. This may impact on valuations. We've been seeing, a number of valuations impacted probably prior to this, or as this was kind of coming out. We've had a couple of valuations come in lower than expected a little bit over the last couple of weeks. So it'd be interesting to see how that develops and just managing that. And like I said, maybe just keeping a bit of extra cash to one side, maybe not over leveraging, just keeping a bit of cash buffer would probably help in case things do go a bit further south.
Yeah, definitely. And on the valuation front, bear in mind, most properties, unless you get investment values, most properties are in the residential space are valued as homes, not investment properties per se. The value of a home is driven often by affordability and mortgages. We're going to see that pressurized as rates go up. So it is probably going to find its way into the market. Now, there's two sides to that conversation. One is if you're remortgaging, if you're trying to go to the upper ends of the loan to values, then you may find that pressured. But on the flip side, it presents more opportunity from a buying perspective. I think we'll start to see values eke down a bit, just as that affordability pressure mounts. Then it will stabilize, and then we'll probably see it carry on and plateau off for a bit. I don't think we're going to see these rocket ships of growth. Certainly not at a macro level. You might find regional pockets, yes. There's always niches and nuance, but that's what I think we're going to see over the next sort of 12 months with this.
Yeah. And, just a point to reiterate from our perspective is there are opportunities out there, and there probably is going to be more opportunities. So, there will be less competition on deals. There will be more motivated sellers for those people who have to move. you're potentially in a better negotiation position. And, there are still plenty of lenders out there. There's competition. Lenders need to lend, that's their business model. And so, yes, rates may have gone up, but there's still plenty of, they haven't just disappeared. It's not like a 2008 crash where lenders disappeared overnight. There's still loads of lenders. It's just, again, get under the weeds, understand exactly what's happening rather than just taking the news for face value. So, opportunity does exist, but you have to be prepared to take those opportunities.
Absolutely. And it's super easy at this juncture now to get into analysis paralysis and just overthink things in that regard. And we're not talking about taking ridiculous risks or undue risk here at all. But again, it can really be driven by, this is a moment in time. We aren't going to be in this environment forever. We don't know how long we're going to be in this environment for. 2 to 5 years if you think back how long 2 and 5 years has been, even though you think it's flown by, but when you start thinking backwards, you think, how much has happened in those 2 to 5 years? And you try and predict 2 to 5 years in the future and how much is likely to happen again in those next 2 to 5 years. You can see that this is just a moment in time that you're locking into your pricing. Lock it in. If it works, lock it in, move on, forget about it, get on to the next one. And there's other ways to maximize portfolios, not just finance costs.
Awesome. Thank you, Mark. So just to close up then, the sentiment from us is, that the market isn't about guessing what happens next, because who knows? It's just about being structured enough to ask the right questions and also, act on the right opportunities when they appear. The investors who tend to do well in these kind of situations and these periods are the ones who they don't rush in, but they also don't step back, and they stay close to the market. They understand what's going on. They stay prepared, and then they can just make decisions quickly and with clarity. So if you're unsure about what you need to do right now, whether you should be buying, refinancing, or simply just sitting tight, maybe because that's best for you, and maybe that's just best for your mental health, then so be it. You have to. That's part of risk, isn't it? In terms of stress. Stress is part of that, and what are you prepared to take on? But yeah, thanks for listening. Thanks for your input, Mark, and we'll see you on the next episode.
Thanks very much. Cheers, guys.
Thank you so much for listening to our podcast. We hope you have learned something and have some tips to take away. We'd be very grateful if you enjoyed the show. You could give us a review and share with anyone that you know that may be interested. And of course, subscribe to the show so you can get notified when a new episode is released. If you'd like us to answer any questions or go deeper on a specific topic, please drop us a message at primeproperty.finance. See you on the next episode.